Would you like to invest in one of the biggest and most legendary financial institutions in the world? Would you like to own shares in a company that forms the backbone of the best economy on the planet? Money makes the world go round, and this company keeps the money flowing. Would you like to have some of that money flow right into your wallet by way of big dividends? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
I want to tell you about a high-quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a big part of the infrastructure of the US economy, an economy which has long been the biggest economy in the world. As the US grows, so does this business. And as the business grows, so do those dividends. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of JPMorgan Chase & Co., which appear to be trading at a significant discount today. JPMorgan Chase & Co., stock ticker JPM, is a financial holding company that operates as one of the largest financial institutions in the United States with over $2.5 trillion in assets. They offer various financial products and services across traditional retail and commercial banking, asset management, and investment banking. Founded in 1799, the bank has a fabled corporate history, intertwining with such magnates as J.P. Morgan, John D. Rockefeller, Thomas Edison, and Andrew Carnegie. JPMorgan Chase is now a $270 billion institution by market cap that employs almost 300,000 people across the world. The bank operates across four major business lines: consumer and community banking, 48% of fiscal year 2019 revenue; corporate and investment bank, 33%; asset and wealth management, 12%; commercial banking, 8%. They also have a corporate business segment that results in insignificant revenue. This bank is massive. The economic infrastructure of the United States can't viably operate without this institution. From retail branches to credit cards to the financial markets, they touch every facet of US finance. If you think the economy of the United States will prosper over the long run, then you have to simultaneously believe that JPMorgan Chase will prosper over the long run. It's almost impossible to separate the two. Admittedly though, banks are basically in the eye of the storm right now. They're going to be directly affected by the pandemic as they form the financial backbone of the economy. There is no way for a large bank to completely avoid losses from bad loans when you have this kind of health and economic crisis. However, the most difficult time to invest in a business, when the outlook is poor and the stock has been beaten down, is often the best time to invest. It's undoubtedly difficult to invest in banks right now. That's why it might just be the best time to invest in banks. Large banks are set up to lead the recovery. As the economy returns to normal, banks will be there to soak up all of that new business. That bodes well for their ability to grow their dividends over the long run. As it sits, this bank has increased their dividend for 9 consecutive years. The 5-year dividend growth rate is 16.2%, which is obviously stellar. That monstrous growth comes on top of a yield of 3.94%. Snagging a 4% yield with double-digit dividend growth is no easy or common feat. By the way, that yield is almost twice as high as what the broader market offers. Furthermore, it's more than 160 basis points higher than the stock's 5-year average yield, relating back to what I noted earlier about valuation and yield. The dividend does remain protected by a payout ratio of 40.7%, and that's even after JPMorgan Chase took a huge loss in the first quarter of fiscal year 2020 to build reserves. While there's no guarantee that politics won't pressure the company on their dividend at some point, especially if the health crisis gets worse, the bank remains fundamentally sound. Looking at business growth, the bank grew its revenue from $102.694 billion in fiscal year 2010 to $115.627 billion in fiscal year 2019. That's a compound annual growth rate of 1.33%. Not a huge growth rate, but it's tough to move a top line forward when it's starting out at over $100 billion. Meanwhile, earnings per share advanced from $3.96 to $10.72 over this period, which is a compound annual growth rate of 11.70%. That's more like it. A 19% reduction in the outstanding share count over the last 10 years has certainly helped create some excess bottom line growth, but much of this is simply due to the bank improving across all aspects of the business. JP Morgan Chase is run by Jamie Dimon, who's routinely heralded as one of the best bank managers in the world. I think the delta between revenue growth and profit growth goes some way toward explaining why that is. They're one of the best run banks out there. Looking forward, CFRA is projecting 5% compound annual growth for the bank over the next 3 years. This would be a notable drop from what the bank has produced over the last decade, but I think it's correct to be cautious here. CFRA's projection was put out on April 14th, which is well after the effects of the pandemic were becoming apparent, and those effects aren't just felt across the broader economy in bad loans. Federal Reserve has also slashed interest rates, which puts further pressure on the spread that banks rely on for profit. This compresses net interest income and net interest margin. A 50% plus drop in near-term earnings per share growth seems warranted, although I still think this bank will do better than that once things return to some kind of normal. Either way, the dividend is covered, and it wouldn't take much bottom line growth to further bolster the dividend and even allow for some modest dividend raises until the bank is in a better position to grow it in a more routine fashion. Moving over to the balance sheet, the bank is in very solid condition. JP Morgan Chase retains the following credit ratings: A2 from Moody's, A- from Standard & Poor's, and AA- from Fitch. These ratings are well into investment grade territory. Profitability is outstanding. The bank routinely puts up robust numbers that are better than the competition in almost every way. Over the last 5 years, the firm has averaged annual net margin of 22.73% and annual return on equity of 11.08%. Net interest margin came in at 2.46% for last fiscal year. Of course, there are risks to consider. Competition, regulation, and litigation are omnipresent risks in every industry. Banks are highly exposed to economic cycles. The upcoming pandemic-induced recession will hurt JP Morgan Chase to an unknown degree. While the sheer size of the bank is an advantage, it also limits their growth prospects by virtue of the law of large numbers. Low interest rates, which now appear to be here to stay for some time, hurt the profitability of banks. Even a well-run bank will be capped on growth. With these risks known, I still think JP Morgan Chase looks like a great long-term investment. It looks even greater after a 35% year-to-date drop in its stock price, which has knocked its market cap down by about $158 billion and has priced in a lot of bad loans. The stock is available for a price-to-earnings ratio of 10.31. This is much lower than the broader market. It's also well off of the stock's 5-year average PE ratio of 12.8. For a best-in-breed bank, that's absurdly low. The price-to-book ratio is 1.2. The current price-to-sales ratio at 2.5 compares very well to the 5-year average of 3.2. And the yield, as noted earlier, is substantially higher than its recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 6.5%. This is a rather middling dividend growth rate for a top-notch bank like this, as they've done so much better than this over the last decade. But I think it makes sense to err on the side of caution. I fully recognize that dividend growth will be challenging, to say the least, over the next year or two, with so much uncertainty. But this is a long-term valuation model. I'm thinking about decades to come, and I have a lot of confidence in JP Morgan Chase when looking out over the long haul. The dividend discount model analysis gives me a fair value of $109.54. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates JPM as a 4-star stock with a fair value estimate of $113. CFRA rates JPM as a 4-star buy with a 12-month target price of $115. I think we have a pretty tight consensus here. Averaging the 3 numbers out gives us a final valuation of $112.51, which would indicate the stock is possibly 23% undervalued. Here's the bottom line, guys. JP Morgan Chase & Co. is a financial powerhouse and best-in-breed company. It's a tough time to invest in a business like this, which is precisely why it might just be the best time to invest in it. With a 4% yield, double-digit dividend growth, a modest payout ratio, and the potential that shares are 23% undervalued, this stock is a very compelling long-term investment idea for dividend growth investors. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, be sure to check the description box below for some important links and additional information. I'll see you next time.